How Buffett uses Munger's psychology to beat the market when everyone loses. Most investors think they lose money because they chose the wrong stock. Warren Buffett and Charlie Munger say that's wrong. You lose money because your brain is wired to make stupid decisions with perfectly good stocks. Today, I'll show you 3 psychological traps Munger warned about and exactly how Buffett avoids them when he invests. By the end of this video, you'll see the stock market completely differently. Welcome to my channel. Here we don't just copy Buffett's portfolio, we try to copy his mind. I take Munger's psychology, Darwin's ideas about survival, and real Buffett investments, and turn them into simple mental models you can use in your own decisions. If that sounds useful, consider subscribing so you don't miss the next breakdown. Charlie Munger once said, "Psychology is an enormously useful tool in the world, and what I have seen in the investment world is that no one uses it." That's the opportunity. Most people study charts. Buffett and Munger study human behavior. If you understand how your brain misjudges risk, reward, and stories, you already have an edge over 90% of the market. Let me walk you through 3 of Munger's favorite psychological forces and show you how they appear in real investing decisions. Bias number 1, social proof, or what I call the crowd is probably right until it destroys you. Humans survived by following the tribe. If everyone ran away from the lion, you ran too. In the stock market, that instinct tells you, if everyone is buying this stock, it must be safe. If everyone is selling, it must be dangerous. That's how bubbles form. .com, meme stocks, AI manias, even housing. The story is always the same. Price goes up, everyone starts talking about it. Your brain confuses popularity with safety. Buffett does the opposite. His famous line is, "Be fearful when others are greedy, and greedy when others are fearful." That's not just a cute quote, it's an anti-social proof operating system. When everyone loves a stock, he assumes expectations are too high and future returns are low. When everyone hates a stock or an entire sector, he starts asking, is this business actually dying, or is the crowd just emotional? Think about his Japan trading companies. For years, they were boring, cheap, and ignored. The crowd didn't care, which meant there was no social proof to tempt him into overpaying. He quietly bought stakes when they were unloved, not when they were on magazine covers. Action for you. The next time you feel excited because everyone is buying this, stop. Ask, if this stock had zero hype and nobody was talking about it, would I still want to own the underlying business? That single question kills social proof more effectively than any indicator. Bias number 2, incentive-caused bias. People don't do what they say, they do what their incentives tell them. Munger said, never, ever think about something else when you should be thinking about the power of incentives. In investing, this shows up everywhere. A fund manager is paid on short-term performance, so he hugs the benchmark and buys what's fashionable. A CEO's bonus is tied to earnings per share, so he might do buybacks at stupid prices or cut R&D just to hit this year's number. An analyst is rewarded for sounding confident, not for being accurate. Buffett and Munger always start with, what is this person paid to do? Not what they say in interviews, what they're incentivized to do. When Buffett holds a company for decades, he loves managers whose incentives are aligned with shareholders. They own a lot of stock, they care about long-term value, not just this quarter's EPS. That's one reason he liked certain insurance managers and operators. The culture and incentive system reward long-term underwriting discipline, not short-term volume. In Darwinian terms, incentives are like the environment. They select which behaviors survive inside a company. If you have the wrong environment, even good people start behaving badly. Action for you. Before you buy any stock, ask 2 simple questions. How is the CEO paid? What behavior does this incentive plan actually reward? If you can't answer that, you don't understand your investment yet, no matter how many ratios you've calculated. Bias number 3 is Munger's favorite concept, the Lollapalooza effect. This is when several psychological forces hit in the same direction and create extreme outcomes. Think about a classic bubble. Social proof. Everyone is talking about it. Incentives. Bankers and brokers make more money if you buy more. Commitment and consistency. You tweeted that this stock is going to the moon, so your ego is attached to being right. Envy. Your friend just doubled their money, and you feel stupid. Individually, each bias is manageable. Together, they create a storm that can override any rational analysis. Munger's insight is that big disasters and big opportunities usually come from multiple biases stacking, not from just one. Buffett uses this by looking for moments when the crowd is under a Lollapalooza trance in the wrong direction. For example, during crises, you often see fear and social proof driving prices way below intrinsic value, forced selling due to leverage, short-term incentives pushing managers to dump assets at any price. That's when he quietly steps in with cash and a calm brain. He's not superhuman, he just recognizes when the environment is pushing everyone else into the same mistake. Action for you. When you see extreme price moves, pause and list the forces. Is there social proof? Are there strong incentives? Is there fear or greed? If you count 3 to 4 powerful forces in the same direction, you might be watching a Lollapalooza in real time. That's your signal to slow down, not speed up. So how does Buffett actually beat the market using psychology? He doesn't predict macro. He doesn't trade every day. He builds a mind that is slightly less vulnerable to these errors than the average investor. 3 simple rules. He designs his environment: quiet office in Omaha, no Wall Street noise, very few people pulling on his attention, a structure that rewards doing nothing most of the time. He uses checklists. Am I buying because the price is low or because everyone is excited? Do I really understand how this business makes money? Are the incentives of management aligned with mine? He accepts being different. Munger said, "It's not supposed to be easy. Anyone who finds it easy is stupid." Being willing to look wrong for a long time is a psychological superpower. You and I may not have Buffett's capital, but we can copy the mental models, one bias at a time. If you're still watching, you're already not the average investor. You care about how your mind works, not just about the next hot stock. In the next video, I'm going to break down one real Buffett investment using these exact psychological lenses, step by step, so you can see how to apply this in your own portfolio. If this helped you see the market differently, do 3 things for me. Hit like so YouTube knows this kind of content matters. Subscribe if you want more Buffett plus Munger psychology breakdowns. Thanks for watching, and remember, price is what you pay, value is what you get, but your mind decides which one you focus on.